What were historical marginal tax rates in the US? Have you ever wondered how the marginal tax rates in the United States have changed over the years? Understanding these rates can give us a clearer picture of economic policies and their impact on society. The marginal tax rate is the percentage of tax applied to the last dollar earned. This means that higher rates affect those with the highest incomes. The modern federal income tax system began in 1913 after the ratification of the 16th Amendment. Initially, the top marginal tax rate was relatively low. However, it increased sharply during times of war and economic crisis. From the 1930s through the early 1960s, the top marginal tax rates were quite high compared to today. For instance, between 1936 and 1963, the top rate hovered around 80 to 90%. This high rate reflected a liberal economic policy aimed at funding government programs and reducing income inequality through progressive taxation. In 1964, the top marginal tax rate was reduced to 77%. Then, it dropped to 70% from 1965 to 1981. During the late 1960s and 1970s, there were some temporary increases, but overall, the top rates remained high compared to later years. Inflation adjustments in 1978 also meant fewer taxpayers were subject to the highest rates. The 1980s brought significant reductions in marginal tax rates under President Ronald Reagan. The top rate fell from 70% to 50% and then further down to 28% by the late 1980s. These reductions were paired with efforts to close tax loopholes and broaden the tax base, which helped maintain government revenue despite lower rates. However, from a liberal viewpoint, these cuts are often seen as contributing to rising income inequality by benefiting the wealthy disproportionately. In the 1990s, the top marginal tax rate increased again to around 39.6% under President Bill Clinton. This change reflected a shift back toward more progressive taxation aimed at addressing budget deficits and funding social programs. Since then, top marginal rates have fluctuated between 35% and 40%, depending on legislative changes. These rates apply to the highest income brackets, while lower brackets are taxed at progressively lower rates. Historically, the United States had very high top marginal tax rates in the mid-20th century. These rates reflected liberal economic policies focused on redistribution and funding public goods. While these rates declined sharply in the 1980s, they partially rebounded in the 1990s and 2000s. From a liberal perspective, higher marginal rates on the wealthy have been an important tool for promoting economic fairness and supporting social programs.